please.
Assalamu alaikum. Distinguished participants, dear colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh. We are pleased to welcome you today to this public hearing session on the newly issued exposure draft of IOFI Financial Accounting Standard on transfer of assets between investment pools. This event is held in collaboration with three major partners: Bahrain Association of Banks, the Arab Monetary Fund, and United Arab Emirates Banks Federation. We would like to thank the partners for their efforts in extending the support in organizing today's public hearing. The public hearing is one of the mandatory steps in the standards development process at IOFI. It is an opportunity for us to interact with and benefit from the knowledge, experience, and wisdom of professional individuals and experts of the industry. The public hearings of IOFI exposure drafts are critical to ensure the final standards live up to market expectations. To provide a very brief history of the making of the standard, in 2018, the IOFI Accounting Board initiated, in addition to working on issuing new standards, a project to review and revise all existing IOFI financial accounting standards. As a result, the board observed that FAS 21, disclosure of transfer of assets, requires a limited revision, especially to align with the revised IOFI conceptual framework for financial reporting and revised FAS 1, general presentation and disclosures in the financial statements. Both revised framework and revised FAS 1 are in effect and are available on the IOFI website. To make this event more interesting and interactive, we encourage live participation. So if the participants have any questions, you may present your questions by clicking on the raise hand button at the bottom of your screen. So you can present your questions directly to the speaker. You can also type in your questions in the Q&A tab. Now, without further ado, let me invite IOFI Secretary General, Mr. Omar Mustafa Ansari, to present the exposure draft and walk you through its main contents. Brother Omar, the floor is open to you.
Thank you very much, Sister Farida. Auzubillahi minash shaitanir rajeem. Bismillahir rahmanir rahim. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Ladies and gentlemen, distinguished guests, Assalamu alaikum wa rahmatullahi wa barakatuh. It's indeed a greatest pleasure for me, like always, to be in front of you and presenting one of our, it's like if you take a normal example, it's more like a artist presenting his artwork. Again, not as I alone, but as AOFI I'm talking about. So it's more like we present it for the public to get an understanding of as to how people look at it. I always quote one of the important quotations from our earlier governance board chairman, that standard setting is not a process that you can complete in a boardroom. Means that obviously the most important part of it, including research and development of the standard, takes place in the boardroom of the respective technical board of AOFI, in this case, the AOFI Accounting Board. But the most important input that is needed is to get stakeholders involved in form of public hearings, roundtables, workshops, and obviously in form of inviting written comments on the standard, so that we are able to understand how industry thinks about it. Similarly, these public hearings also work in the direction of actually helping the implementation of our standards in order to people understand what the standard is about and how it is going to impact their financial statements or their operations or their governance framework, etc., as the case may be. So I do not want to take that much time on this one. Only thing is that, as Sister Farida already mentioned, that maximum interaction and the maximum input is what is expected from this. And as far as possible, we'll try to take questions by allowing you to open up your mics and screens as well. But if the time does not permit, we will be taking questions only by Q&A tab. Another important thing I would like to mention, that every comment that you make here is very important for us. And even if I try to respond some of those comments and try to clarify some of them and clarify your understanding in view of what discussions have taken place at the level of the of the board, the working group, the Sharia committee, etc. But the purpose of getting your comments is to make sure that we get the feedback, and that whole feedback, irrespective of any answer provided to you or any clarification provided to you, which is part of the process, is still all the feedback is taken to the working group and to the board. So please feel free to be interactive and to be contributing as much as possible. I think, Sister Farida, if you can confirm, this is the third public hearing on this standard. I think so. And this one, we are holding only 3 public hearings. Am I right?
Yes, this is the third public hearing, and the Arabic one will be held maybe in October.
Okay, so only the Arabic one will be held after this. Otherwise, this is the final public hearing for this standard. Some of you might have even early adopted, maybe attended the earlier public hearing on this topic also, and may have got some of the opportunity to attend some public hearing on the connected projects. The connected projects include the quasi-equity of balance sheet asset under management and control standard. These all 4 together are part of one combined project of revision of FAS 27 and FAS on transfer of assets. So considering the significance of this one, I would request all of you to be attentive and interactive. Now, coming to a little bit about the need and rationale for this standard. AOFI already has a standard on transfer of assets, financial accounting standard on transfer of assets. So when we were doing our financial accounting standards revision project, we identified that this standard is good, but it might need some limited scope revision. Now, limited scope revision was necessary because we were revising the quasi-equity of balance sheet asset under management and control standards, and we have already revised the financial accounting standard number 1 and the framework. So we had to align them together. And in addition to that, there are certain significant issues that we noted related to Sharia compliance, like, for example, the tangibility in case of transfers, or the risk of buyback in case of transfers between pools or between the shareholders versus the investment pool. So considering all these things as relevant to this subject, we decided initially to have a limited scope revision, but I would say that now it is slightly more than limited scope revision. Although the main requirements of the standard remain intact, but some of the disclosure requirements and some of the accounting policies related requirements and some of the treatment related requirements or Sharia compliance related requirements have been enhanced and improved. I can see a comment in the Q&A tab, anonymous attendee. What is meant by quasi-equity? Assalamu alaikum and welcome. And first, my request for everybody to please rename yourselves with your name, and if possible, also with the name of your organization. So whenever you put a question in tab, or if you raise your hand, we are able to identify you properly. So your name might be good enough in most situations, but in some situations, if you want to mention your organization name also, you can do that, and you can always do it by renaming yourself in Zoom. This is an easy option available. Now, quick answer to that, because since it is important, according to AOFI standards, financial accounting standards, and the framework of AOFI, there are several Islamic finance transaction structures which have a characteristic of equity primarily, but also have a characteristic of liability. So, for example, when you open an account in Islamic bank as a saving account or as a deposit account, most of these accounts are based on mudarba, and these are based on unrestricted mudarba contract, which means that the bank has the right to use your money for your benefit eventually, but as per bank's discretion on an unrestricted basis. This becomes an unrestricted investment account or based on unrestricted mudarba contract. Now, if you see that according to the core characteristics of the contract, you are taking the risk on the underlying assets. Risks and rewards on the underlying assets means that you are entitled to get profit from that, and you are you are subject to any risk on that. Any profit on that deposit is not guaranteed. Even the principal amount of that profit, investment or that deposit is not guaranteed. So this is completely different from the mechanism where you have the conventional deposits in which the interest as well as the principal both are guaranteed. So here, the first thing is that these have a characteristic of equity because these instruments share the underlying the risks and rewards of the underlying assets, and the net assets they have interest in the net assets of the investment pool or of the institution, whatever the case may be. So this is the primary characteristic of such instrument, that is being equity. However, these instruments also have an element of liability. Now, according to IFRS, if any instrument, even if having equity characteristics, has a put option, means that either it has a redemption or a fixed date of redemption can be done through fixed maturity date, or it can be done prior to fixed maturity date, or it can be done on demand, like in case of saving accounts. So in all these situations, because of having a maturity or a put option, the element of liability is existing. According to IFRS, all the items of financial statement or elements of financial statement of products and balances that have a put option are classified as liability. However, according to Sharia, these instruments that we are talking about have a primary characteristic of equity, and they are not liability because they are not, the principal or the interest is not guaranteed, or profit thereon is not guaranteed. So according to the AOFI's framework, equity of unrestricted investment accounts have always been kept separate from the equity as well as from the liabilities as a third component between equity and liability. Several years back, when AOFI revised its financial accounting framework on FAS 1, since we identified that in addition to the unrestricted investment account, there are other type of similar instruments as well. So we came up with a broader definition called quasi-equity, which includes unrestricted investment accounts, some type of sukuk, some other instruments like musharaka, etc. as well. I know that I have taken a bit time on defining this thing, but I think it might be quite useful for some of the participants who are new to the subject. With that, I would request again that you may kindly rename yourself so that every time a person puts a question is identifiable. Thank you very much. Sister Farida, I can note some of the board members and senior people joining in, particularly any board member as like Brother Handamir. I can see him on the list. So if any other board member or have also joined in, you can just try to update them. My request is that please kindly upgrade Brother Handamir as one of the panelists. We have a hand raised by Brother Muhammad Khalid Muqeem. Can you allow Brother Muhammad Khalid Muqeem to open up his mic? And is it necessary to upgrade as panelist, or you can just allow as a attendee also to you switch on the mic? Anyway, I think I can see that you have upgraded Brother Muhammad Khalid Muqeem as panelist. So Brother Muhammad Khalid Muqeem, please go ahead with your question. Brother Khalid Muqeem, you have a question? Please go ahead. Your hand is raised. Okay, I think he has put a question, put just salam in the chat box, so I think we can move ahead. Okay, so with regard to this topic of this standard, one of the biggest challenges for Islamic financial institutions is that at times they have more than one investment pools, or they have different type of stakeholders involved in the entity. So, for example, and it is quite possible that an Islamic financial institution like Islamic Bank may have assets which are funded by the shareholders alone, versus assets which are funded by the unrestricted investment accounts. Similarly, it is also possible that some banks may have more than one pools of unrestricted investment accounts. Having more than one pool, again, this is not my subject for today, but having more than one pool at times is important to match the expected returns or to segregate the assets with different risk characteristics and keeping the investment accounts which are like, taking those higher risk in that one. At times it is done because of short-term maturity, like for financial institutions. At times short-term maturity investment pools are created. At times you have separate investment pools for high net worth individuals having long-term assets with long-term deposits. So the maturity matching, the return matching, risk and reward matching, a segregation of risk and reward. So there are different reasons why different Islamic financial institutions or Islamic banks may have different investment pools within the same bank. Similarly, it is also possible that a bank may have an investment pool for unrestricted investment accounts, but also it may have an additional investment pool for tier 2 sukuk, which may also be based on unrestricted mudarba. I'm just giving you example. The point is that in most of Islamic financial institutions, particularly the Islamic banks, it is quite common to have more than one set of stakeholders, and at times all the stakeholders, all such stakeholders who are participatory in nature, means that they are taking risk on the assets and having the profits and risk of losses. They actually are not sharing the same set of assets. Rather, the underlying assets for different stakeholders become different, which is not commonly referred to as investment pool, or only sort of like pool. Pool management itself has a lot of governance issues and governance challenges. AOFI right now is working on a governance standard for investment accounts also, which will be addressing some of the issues related to this one. Actually, the standard is towards finalization as in form of exposure draft. Probably in the next meeting of the AOFI Governance and Ethics Board, that exposure draft will be finalized. That also covers some of the aspects of transfer of assets from the governance side. Right now in this standard, we are talking about transfer of assets between pools and between shareholders and different stakeholders in form of in form of internal sort of sale contract or execution of a internal transfer again exchange based transfer. So considering all these things, it is like it is very imperative to have proper financial reporting requirements for that, and that financial reporting requirement are not only important for the purpose of disclosures, but they are also important for the purpose of selection of right accounting policies and right accounting treatments, and assigning the right values at the time of transfer. This assigning the right values at the time of transfer is very much important for ensuring justice and fairness between the stakeholders. So for example, if there is a high return yielding asset which I transfer from a common investment pool to shareholders, it may create a conflict of interest that now shareholders are getting higher return as compared to the investment account holders who are getting a lower return because their average rate of return on the pool of assets reduces. Similarly, it is possible that there is a high net worth individual and for which Islamic financial institution want to create a separate pool, and that pool all major I won't say major, rather all high return yielding assets are transferred to that pool. So these things are, again, as I mentioned, these have their own governance issues and Sharia issues and fairness and equity issues, but additionally, the accounting practices that are to be there are to be very much clear with regard to what will be the values assigned, what accounting policies will be applied on these type of transfers, how to ensure fairness and equity on this one, as well as how to manage risk at the greater level. So there are so many challenges with that. Some of that are discussed in this standard, and obviously remaining will be discussed in the governance standard. Now I would like to take you through the standard. So if you allow me to screen, I'm allowed to share my screen. So I believe you all can see my screen. Oh, now I can see some comments in the Q&A tab. Okay, the first one is from Hikmat Amin. What is the difference in financial risk for financial institution between owner's equity, quasi-equity, and off-balance sheet asset under management of an institution? Brother Hikmat Amin, what do you mean here by financial risk? Because financial risk is not one type of risk, how we define it. So the point is that what I was saying, if your question is related to what I was saying and I was not very clear to you, in that situation, I would like to clarify that the risk and reward related to different assets are different, and you need to match them with the risk-taking appetite of the investment account holder. So, for example, you have some equity, some investments in the stock market, which is subject to too much fluctuation. Investment account holders, unrestricted investment account holders who open up accounts with you normally are not putting the money for only for this type of activity, because at times when you talk about a bank, a person investing with a bank has a back-end objective in mind with regard to safeguard of the money. Safekeeping of the money. So the safekeeping of the money may not be possible if the Islamic financial institution start utilizing the monies of the quasi-equity holders, that is unrestricted investment account holders, on a very risky transactions, or at least the common investors. However, some Islamic banks may have off-balance sheet asset under management under a restricted investment account mechanism, in which they can have stock market investments or high-risk investments also, because high-risk investment also normally entail high returns. So that has to match with the risk appetite of the investment investment account holder. So investment account holders' risk appetite is relevant. Now, shareholders can take greater risk on stock investment. Similarly, for example, there is an Islamic bank that opens up its subsidiary in another country. So would it be appropriate that investment goes out of the unrestricted investment accounts, or would it be important that this investment is taken out from the shareholders' funds only? I'm just giving you some examples. So the financial risk of the underlying assets are important, and the risk appetite of the investors are important, and both of them should match with each other. I hope I'm able to clarify your query, but if it still is not clear, then please explain your question in more detail, particularly emphasizing what you mean by financial risk here. Thank you very much for your question. There is comment from Sister Ghaliyatul Shamri. Assalamu alaikum and welcome, sister. Assalamu alaikum wa rahmatullahi wa barakatuh. Does the transfer of asset between investment pools necessitate the termination of contract signed with the clients and change it? For example, when transferring asset between off-balance sheet accounts and quasi-equity, that will lead to a change in the nature of the signed contract between the Islamic financial institution and the customer from a restricted mudarba contract, for example, to a contract of unrestricted mudarba. Sister, what happens is that it is not that you do not normally, when we talk about transfer of asset, we do not talk about transfer of the investment account holder. So at times, yes, unrestricted investment account holders are also transferred from one investment pool within the URIA unrestricted investment accounts to another unrestricted investment account pool. This is possible on a rare basis, not commonly. But that does not change the type of relationship. But the example that you have mentioned is changing the type of relationship. So it does not happen like that. But yes, it is still possible that some assets are transferred from the off-balance sheet asset management to on-balance sheet asset. So this is or vice versa. This is a common practice. But sister, it is not. We are not talking about transfer of the investment account holder from one pool to another. We are right now talking about the transfer of the underlying assets, which means that the contract with the respective party remains intact. Now, what happens that, for example, there is a restricted investment pool where there were 5 million BD of investment. Now, there was one customer that comes and he says that I want to withdraw my 1 million BD, which means that the investment pool will become 4 million BD. Now, investment pool will not be having assets of cash of 1 million BD. It will be having assets of 5 million BD. So from where the cash comes, one option is that the investment pool encashes one of the investment assets, like equaling to 1 million BD. But it is possible that you don't find the right customer, or you don't find the right price, or if it is a transaction of financing. For example, if it is sukuk, you can try to sell it. But if it's a financing transaction, you can't sell that transaction easily in the market. So what happens that you need to bring cash out of the shareholders pool and transfer this asset to the shareholders pool. Or it is possible that the same day, some of the customers were added on the unrestricted investment account. So you needed 1 million BD of assets more in the urea pool. So from the RIA pool, that is off balance sheet, you bring that asset to the urea pool, which is on balance sheet. So the nature of the contract of the investment account holder does not change, sister. Only the underlying assets change. And underlying asset change normally is because of some reason. For example, as I mentioned, that one of the customers having encashment. Another situation was that one of the customers may come and make additional investment. So now, for example, in the urea pool, you got 2 million BDs additional today. Now, what happens that you need to then transfer some assets from the, for sure, you need to try to use that money for creating new assets, but at times you need to transfer these assets from another pool. Similarly, the bank is short of liquidity. It needs to create a wakala or mudarba-based pool for financial institutions. So that wakala-based pool, which can be off balance sheet, and mudarba-based pool, which is on balance sheet, both may need some assets to be transferred from the common urea pool. So these are the common examples. We'll go through the standard, which will identify a different type of transfers that actually take place, for which you need to set up your accounting policies. Even other than Islamic banks, these type of transactions also happen in some other Islamic financial institutions also. For example, in case of Takaful. In Takaful, you have the shareholders fund, you have the participants Takaful fund, and in case of family Takaful, you also have a participants investment fund. Combining these things, you might need to apply different different accounting policies to make sure that the transactions take place on the basis of fairness and equity. Mr. Ghalia has another question. Will the application of this standard and the transfer between investment pools affect the priority of investment funds, especially when transferring between a quasi-equity pool and equity pool, which lead to the investment priority being for shareholder fund and not the funds of the quasi-equity accounts? Sister, it's an excellent question, but this is not the issue of the accounting standard. Accounting standard only says that develop accounting policy which is consistently used and it is based on fairness and equity. And then it says that you have to disclose that accounting policy and you have to disclose the transfers. So what happens that, transparency and disclosure itself works as a deterrent against incorrect practices. So that is what we are expecting from this one. However, whether to give priority or not to give priority, the quasi-equity standard of AOFI and current FAS 27, they don't say you give priority to this one or that one. They say that you disclose to whom you are giving priority, because it's an accounting standard. Accounting standard cannot dictate that you give priority to this one or that one. Now, who can dictate about the priority? Number one, it is the Sharia requirements, which define that you give priorities based on the mutual benefit, not based on one party getting a benefit. It is based on governance practices on which we are developing the governance standard. It is based on the regulatory practices where regulator actually intervenes and put regulations how to do this thing. And also it depends on the contractual arrangement that in some situation, the contracts with some of the parties actually put a priority in the contractual requirements. So giving the priority, sister, is not an accounting issue. Accounting issue is reflecting what is correct. If the transaction is not taking place at fair value, and fair value is the justice and equity, if it is not taking on fair value, then you need to disclose it's not happening on fair value, and you need to disclose the difference between fair value and the transfer value. But this is accounting. This is financial reporting. Financial reporting reflects what is happening in the business. Financial reporting has better transparency and disclosure so that people can take informed decisions. So if there is an institution who is always giving priority to the investment, to the shareholders, this can be identified from the financial statements. A good analyst can identify it from the financial statements. But accounting standard cannot say do this or don't do this. Accounting standard can say that normally this transaction can takes place on fair value. But so if you do it at fair value, disclose. If you don't do it at fair value, disclose the accounting policy which is applied and disclose the effect of the difference between the fair value and others. So from that perspective, accounting standard can work as a deterrent through having better transparency and disclosure, but it cannot work as a replacement for the governance, Sharia, regulatory, and contractual requirements. Dr. Mohammad Mukhtar Khan, can AOFI take the initiative of starting Islamic finance in India at government level? Brother Dr. Mohammad Mukhtar Khan, thank you very much for joining us. And I believe you are joining from India, or you belong originally to India. So thank you very much for that. Sir, I think that some of the Islamic finance initiatives are on the way in India at the private level, but without actually, because there are some funds and there are some microfinance activity, and there is, again, India is probably world's second or third largest Muslim population, and according to some people, it's the world's biggest or the largest Muslim population. So from that perspective, it is very important that that Muslims of India can try to do it. But I can tell you, to be honest, as per my understanding, in Kerala, there is an investment bank sort of that has been based on this Islamic finance. There are some Islamic Sharia compliant mutual funds, some cooperative societies, some microfinance activity. But you know, this thing has to be this has to be done, like, you know, as an initiative in all, even the Muslim countries. I'm not saying Islamic countries, I'm saying Muslim countries, means that Muslim dominated and Muslim majority countries, even some of them did not start it at the government level, or rather most of them did not start it at the government level. Government level functioning of our Islamic finance started when the commercial benefit was identified. I can assure you that as soon as it starts, the commercial benefit can be observed even by the Indian government. Russia has much smaller Muslim population. UK has much smaller Muslim population. Singapore has Muslim minority. Germany has much smaller Muslim population. France has much smaller Muslim population. But all these countries that I'm talking about have government level involvement now in Islamic finance, because they feel that it has the benefit of financial inclusion for their respective populations, as well as they have an opportunity to attract investments which are based on Sharia compliant, Sharia compliant banking or Sharia compliant finance. So they can attract more and more investments in their respective countries. So Russia is talking about food security. India has a great opportunity that if Muslims of India take some initiative with regard to having a financial Islamic finance model for establishing food security for the region, I think they may have a great opportunity. I'm just mentioning this thing that AOFI as a standard setting body may not have any influence on any government, or cannot approach any of the governments, either Muslim government or Muslim minority government. But what we can do and what we can assure you is that in any new market where Islamic finance is being developed, AOFI is available to support support the regulators, the governments, and the market participants. We have a significant focus on developing markets we work on the capacity building in those countries. We work with we promote our standards being adopted as a starting point, which gives these countries a better opportunity to start Islamic finance operations based on tried and tested global practices. So we are open for all these sort of collaborations with any government as well as private initiatives in the developing markets for Islamic finance. There we have some working group members and some collaboration with some of the experts from India, either based in India or based in some other parts of the Muslim world. But Allah subhanahu wa ta'ala says that in the Holy Quran, the meaning of that is that Allah subhanahu wa ta'ala never changes the situation of a nation or ummah that doesn't try to change themselves. So this is something that has to come from the grassroots level. And then obviously AOFI and all the Islamic finance infrastructure bodies and institutions like Islamic Development Bank, etc., can come and help on that. One most important thing, as I mentioned, I gave you just one example of food security, but India has a huge industrial sector. It has huge services sector. So it has great opportunity for investments under Islamic finance modes. So that is something on which actually internal initiatives are needed. I well understand that in some parts of India, there are Muslim communities are comparatively more involved in business and hold significant influence in the economics of those states. Maybe Kerala and maybe Gujarat might be good examples for that. Even there are states where Muslim population is quite high, so there can be opportunities on that part. My point is, some initiative has to come from inside, and then international infrastructure institutions for Islamic finance can help that, inshallah. Thank you very much for being with us. Sister Ghaliyat Shamri, okay, my pleasure, sister. Okay, now, Brother Hujjatullah Barati, what are the ways to transfer of asset from one investment pool to another investment pool, and what could be accounting treatment? Brother, if you allow me to go through the standard, you will get answer to your questions. So I'll answer it in due course. Sister Rajda and Anapur also, again, she joins us from India, and welcome, sister. So yes, even the mutual funds offered in India that are Sharia based are names are ethical funds and not Islamic for obvious reasons. I can simply tell that our prayers are with you, our brothers and sisters from India, and we hope that being one of the biggest Muslim populations, you are able to have more of Islamic finance. So with regard to this, I cannot say anything more except for yes, things are happening, and yes, these are named at times not as Islamic, but this is happening even in some of the Muslim countries. I can tell you some of the Muslim countries having a secular constitution are not calling it Islamic finance or a Sharia finance. They are calling it participation finance or ethical finance. So these are the limitations everywhere. Only thing is that we need to work our part for this. Anonymous attendee, again, ICF Indian Center for Islamic Finance is carrying out efforts to implement in India. Moreover, under Cooperative Society Act, financial services are being provided successfully. Thank you very much for updating and confirming my understanding. We have comment from Saleh Tayullah. And again, my apologies, people from around the globe actually join in. And at times, I feel sorry that if I'm unable to pronounce your name very correctly. So my apologies in advance to all of you. So thank you for your lecture. I'm Saleh Tayullah from Sudan. My question is, how can we disclose and manage the losses arising from the risk and damage of asset because of crisis and war? Example, the damage of bank sectors in Sudan. Brother Saleh, it's a very good question, but unfortunately, it's not related to this topic. So the problem is that if I go in details about this issue, it will impact the today's public hearing and will reduce the time available for the core subject of today. So with my due apologies, I would like to refrain from answering your question. If in the end time allows, we will allow you to put this question again. Brother Ismail Abdul Rahim, thank you for the presentation. It is our pleasure, Brother Ismail, but to be honest, till now, I haven't started my presentation. So thank you again in advance for that. And I hope that it's not your leaving message. I hope that you are going to continue with us. Thank you again. Dr. Mukhtar, since it's not related to the today's topic, so I would just like to mention that you can always approach us at AOFI to have any assistance that you would like with regard to capacity building, guidance on the products, etc. as well. So, but I will not like to discuss further this issue again because it is not related to our today's subject. But again, thank you for joining us. And Sister Farida, if you can provide the contact details for AOFI for the comments, accounting@aofi.com, and anybody who want to approach me for any of the initiatives in their respective country, etc., you can put my email address in the chat window as well, please. So anybody who want to approach AOFI can approach me by my email address, oansari@aofi.com. I've requested Sister Farida to put my email address on that, as well as any comments that you want to provide on this standard or any other exposure draft. You can do it. You can do it quickly. Sister Farida, if you can do it quickly, and then you can provide. Everybody can provide comments on these email addresses and approach us at my email address. There is comment from Brother Nasser Al-Bikawi, and he is thanking us. Thank you very much, brother, for your prayers. Rahul Chaturvedi, is the purpose of target fund needs to be same as the original one? A very good question. Actually, it is not always necessary, but the contractual, the contractual arrangements are normally different. So, or the risk appetite is different. At times, the contractual arrangement is different. So, for example, if you are transferring from restricted investment account to unrestricted investment account, the contractual arrangement between the investors is different. But the target funds normally target fund may have different risk profiles and may have different investment objectives as well. So, it is not always the same. Technically speaking, at times they will not be the same. So it's not required to be the same, but rather in most cases it may not be the same. Thank you very much for a good question. Ismail Abdul Rahim, brother, has a question. How does the transfer of assets between investment pools impact the overall financial stability and risk management of the organization? Brother Ismail, this is an excellent question, to be honest. The point is, number one, about the financial stability. So the question is that at times these transfers take place for the greater financial stability of the institution. So, for example, there is an institution which has only one. Let's take example. There is an institution that has only one investment pool for urea accounts, and only shareholders fund the fixed assets and other assets. Okay, now the institution has lack of liquidity right now. It needs liquidity. What happens? It may go to the market or interbank market. It may take money. Okay, it may take money on tawarruk basis, which is not preferred mode by AOFI, and it is not preferred mode by a lot of scholars, and some of the countries even prohibit tawarruk. So now, what option it does have normally other than tawarruk? The other option is it will go to the market and get funds based on wakala or mudarba. Most common other than tawarruk. Again, tawarruk not allowed in all markets and not preferred by AOFI standards. So now what happens that if you take money on wakala or mudarba basis, you need to have an asset for that. So for that, you will transfer some high yielding assets and more secure assets. Say, for example, you will take out some of the sukuk, which are highly liquid, less risky, have a higher rating, and you will take those sukuk and transfer them to a different pool called FI pool, financial institution pool. And the money that you are taking from other financial institution will be invested under Wakala mode or Mudarba mode in this pool. So now this transfer of asset actually manages the liquidity risk. It helps in overall financial stability of the institution, because otherwise the institution would have been subject to subject to liquidity risk, and it may even fail to fulfill its obligations with regard to the cash payments to the UREA account holders who are withdrawing. Now, all assets in the UREA pool are not encashable at the time, because financings, particularly investments in sukuk and others, may have an active market where you can sell them. But for others, you may not even have this thing. At times, it is possible that you have available to you had to maturity sukuk. So even if they are tradable, but you don't want to trade them because you have held to maturity, and if you do not comply with the held to maturity conditions, you will not be able to keep other sukuk in future as held to maturity. So it means that you cannot sell those instruments. You can only transfer those instruments from the common pool, common UREA pool, to the special pool for high net worth individuals or for FI, because you want to manage your risk. So this is very well understood that the transfer of assets should normally take place in the greater interest of the overall institution, including all stakeholders. So now we know that FIs and high net worth individual in this case are getting a higher return than the UREA pool, and some high yielding and more risk-free or less risky assets have been transferred to them. Still, it was in the greater interest to have the overall financial stability and having better financial liquidity risk management of the organization. Brother Ismail, I have given you just one or two examples to explain how it works, but I can assure you that at times pool management, a very good mechanism of pool management is needed to have better risk management for the overall institution, because Islamic financial institutions are subject to unique risk because of these unique type of structures. And it is very important that you exercise very good risk management practices and strategies, including a good system of pool management and a good system of, again, this thing should happen with the minimum impact on any of the parties. It should be happening in the greater interest of the institution. It should happen with reasonable level of justice and equity. But I thank you very much, Brother Ismail, for having a very good question. Again, I would say that I would love to discuss this issue more, but this is not the accounting issue. Again, it is more of the governance issue and the regulatory issue. So from that perspective, I would stop here and will not go in further details. And I believe that the basic answer that I have provided to you would be good enough. Brother Saud Al-Khudair has a question. How to make balance between booking the IFRS investment, IFRS, and then I can't see, you have written IFRS AA investment account pools, I think, and its related accounting entries. The problem is, if IFRS was covering all of these requirements, we don't need AOFI to develop accounting standards. That's very simple. AOFI has a clear accounting standard setting strategy. AOFI says that we develop accounting standards only where the generally accepted accounting principles, which are mainly IFRS, are not addressing some of the Sharia issues or some of the unique business model related challenges which come because of the business model of Islamic financial institution or because of the transaction structure. So unfortunately, this is not something which is addressed by IFRS. AOFI does not want to say that IFRS standards are bad standards. No, we are just saying they are very good quality standard and we try to align with IFRS standards. But what we are doing is that we are trying to align our accounting standards with IFRS, except for the areas where we can do value addition. And that value addition comes only by ensuring compliance with Sharia principles and rules, like tangibility issue that we have discussed in this standard, that we will not find in IFRS, because IFRS is never concerned about that. Similarly, the business model and the structure and these internal transfers, IFRS does not have any accounting treatment with regard to the transfer of ownership between the internal stakeholders like this, as I'm talking about. It's about financial reporting to the outsiders. But for us, the outsiders include some of the stakeholders like investment account holders whose interest is impacted by the internal transactions also. So these internal transactions, from our perspective, are to be addressed according to the AOFI standards. I think, brother, now you have clarified your question because of the typing error, you have corrected it. But in a nutshell, I believe that I have answered your question, brother. So now this is like, nearly we have spent half of the time and we have not yet started the presentation. So now please allow me to start the presentation. And after every section, I will take your comments. I would like to thank you all for being here in big numbers and providing very good comments and questions. So with that, I'll take you forward. Preface and this introduction part, I think I have covered most of it. But only one thing I would like to mention, that the earlier standard, number 21, disclosure on transfer of assets. It was about disclosure on transfer of assets, while we have named it on transfer of assets. Why? Because we, in addition to disclosures, we have covered the guidance on selection and adoption of accounting policies, and about some of the other general accounting treatments as well. So we have slightly increased the scope, and the revised accounting policies disclosure was required even earlier, but we have required for adoption and development of accounting policies, ensuring as far as fair treatment and having a consistent application over a period of time. We have aligned the terminology and definitions with the new framework, and we have aligned the requirements with the new Financial Accounting Standard 1, particularly with regard to presentation and disclosures and the elements of financial statement. Financial reporting requirements are aligned with the Sharia requirements of transfer of assets, for it has particularly two main issues about transfer of assets by providing definition of tangibility ratio, monetary asset and non-monetary asset. Sister Farida, if you can just make a note of it. We have also considered avoidance of buyback situation. So that is also, again, Sharia issues that are addressed are two in nature. One is about tangibility ratio, and the second is about the buyback, the risk of buyback. So avoidance of buyback and etc. We have covered that. The objective of this, and just please make a note of it, because regarding buyback, we need to align with what we are writing in the governance standard also. So before finalization of this standard, we need to align with the views of the governance board also. Okay, so now I'll not read the whole of the standard, but some of the important sections I will read out to you. The objective of this standard is to establish the financial reporting principles that apply in respect of internal transfer of assets between various investment pools of an Islamic financial institution. As I mentioned, it applies mainly to the banks, but it also applies to, in the scope, we will see that it also applies to other type of asset, institutions as well. The standard shall apply to all transfers between investment pools related to and where material between significant categories of. When we say significant categories of, it means that even the urea in some countries and some banks, you will have a practice where the urea that is unrestricted investment account may have 20 different pools. Similarly, there can be pools based on different currencies, so pools based on different type of investments, etc. So considering these things, it is also possible that within quasi-equity or within off-balance sheet assets under management, you can have more than one categories. The standard transferred for the purpose The assets transferred for the purpose of the application of this standard include all monetary and non-monetary assets. And as I mentioned, it will apply to banks, but also apply to asset management and investment banks, any other type of any other type of Islamic financial institution which has multiple funds being managed within the institution or sub funds being managed within the institution, and it will include takaful, etc. as well. I can see some people have comments on the chat window. So honestly, I don't know if there is a question. In the question, I honestly cannot take those questions from the chat window. I cannot go to all that discussion. So if anybody has put questions in the chat window, please kindly copy that in the Q&A tab. Now coming to the important definition, investment pool in the specific context of this standard comprises of distinct assets whose risks and rewards wholly or proportionately are attributable to the funding provided by respective investors within owners' equity, quasi-equity, and off-balance sheet assets under management of an institution. It is generally a virtual entity. Now, from our perspective, because the set of stakeholders for this is different, so it is a virtual entity, and at times a separate reporting entity means that in some situations it can be a separate reporting entity and reported in a different form, but at times it will not be having a full reporting entity. So for example, in some of the restricted investment accounts may become a reporting entity as well. Some of the, if anything takes form of a legal entity, that becomes a completely different institution. But even without taking a form of a legal entity, it can become a separate reporting entity as well in some situations. But generally speaking, all investment pool are a virtual entity. Being a virtual entity means that they have a set of owners in form of equity or quasi-equity, etc., who are under a contract like, Mudarba, Musharka, etc., and who own the risks and rewards incidental to ownership of the underlying assets. Monetary assets in the specific context of this standard include cash, contractual right to receive cash on another monetary asset, and contractual right to exchange a monetary asset with another institution or entity. Non-monetary assets in the specific context of the standard for the computation of tangibility ratio in line with Sharia principles and rules may include tangible assets, that is assets that are physical, such as property, plant, and equipment, and inventory, equity instruments, sukuk or other instruments whereby the majority of underlying assets are tangible assets, and intangible assets, for example, right of use assets. Sharia principles and rules. AOFI has a Sharia principles and rules definition, which is defined in form of a hierarchy comprising of AOFI Sharia standards, country Sharia regulations, central Sharia boards rulings, and financial accounting standards of AOFI insofar as these have Sharia requirements. And the last is the Sharia board of the institution. This hierarchy is standard across AOFI accounting and governance standards. So we have just put it in the footnote instead of defining it again completely. Tangibility ratio in the specific context of the standard is the ratio defined by an institution in line with Sharia principles and rules acceptable for the purpose of transfer of an asset or a bundle of asset from investment pool to another when it involves debt. Now, let me give you an example. We all know that selling of debt at a price other than par value in Sharia is not acceptable. According to certain scholars, a sale of debt is not acceptable, but AOFI has a specific standard on sale of debt. Now, sale of debt standard puts all these conditions with regard to when an asset can be transferred, which asset which is in form of debt can be transferred, and at what conditions it can be transferred to the counterparty, and how it will be treated. So from that perspective, it is very imperative to understand that cash that are receivable cannot be exchanged against cash unless it is equal to par value of the receivable. Now, par value of a Murabha receivable might include the profit. So for example, I purchased the goods for 100 and sold for 120. So my par value of receivable is 120. And now, but that 120 is to be received after 1 year. Now, if I want to transfer that Murabha asset, Murabha receivable to another outside party, the sale of debt standard applies. But here we have clarified that since the stakeholders of different pools are different and they have different ownership structures, so from that perspective, each pool is a virtual entity. So the tangibility ratio related requirements for sale of debt also apply on the internal transfer. So what happens that if I transfer only a Murabha receivable. I cannot transfer it at a net value. I have to transfer it at the par value. Net value may include the deferred profits with regard to that, because that deferred profit of 20 in my example is to be amortized over a period of 1 year. But since sale of debt is prohibited in Sharia at value different than the par value, so it is not practicable. And we have seen Islamic banks and financial institutions having Sharia non-compliances in this one. This is actually coming from the views of some of the scholars and the personal experience that I have gained, and some other of our working group and board members and Sharia scholars who are part of the working group, they all have understood that. So from that perspective, we believe that the tangibility ratio does not apply only on that transaction with outsiders, but also with the internal stakeholders within the institution. So you cannot just transfer one receivable at a value different than that. But what happens if you transfer a bundle of assets? So that bundle of asset can take form of 40% of Murabha assets and 30% of Ijara assets and 30% of Sukuk. So together, we can have a tangibility ratio criteria met here. Now, sale of debt standard has a tangibility ratio criteria for making things tradable normally at 51%. And in case of Sukuk, it makes it that 51% being tangible assets, non-monetary assets. So from that perspective, it is even possible that Sukuk perspective, temporary relaxation of up to 33% is required. This is not a Sharia standard. So we are just saying that tangibility ratio applied should be disclosed, and accounting policy should be considering these disclosures and all these things. And tangibility ratio, you should disclose and you should mention about the tangibility ratio being followed. So transparency has to be there. But this is the accounting standard. Accounting standard cannot go in more detail than that. So from that perspective, we have talked about disclosure and some minimum requirements with regard to tangibility ratio. And again, as I mentioned, that some of the accounting standards may contain some deterrents with regard to wrong practices. So having a tangibility ratio requirement here actually creates a deterrence on that. And again, I would say that the brother who talked about IFRS, I would like to mention that honestly, we would love to apply IFRS if IFRS was going to address all these issues. Unfortunately, IFRS, Islamic finance industry is very small, and they do not consider the Sharia requirements and these specific business model issues of Islamic finance. And that is why AOFI standards are necessary. And actually, that is why we believe that AOFI accounting standards are equally important to be adopted. It's not sufficient that you just adopt AOFI Sharia standards, because having Sharia standards in place cannot be fully implemented unless you don't have the governance and control requirements which are contained in AOFI's governance standards, unless you don't follow the good ethical practices which are contained in AOFI's ethics standards. It will not work unless you record and transact and report and be transparent in line with the accounting requirements which are suited for those Sharia compliant transactions and structures which actually come from the AOFI accounting standard. And that is why we believe that all of it, and along with AOFI's auditing and Sharia auditing standards, it actually works as a combined sort of a bunch of standards which complement each other. And again, I do not want to address this issue about whether IFRS adoption can be suited for Islamic finance or not, but I can assure you that if we had any reasons to believe that IFRS adoption can be enough for Islamic finance, we would have decided not to develop any standards. And again, why to take these additional pains? Developing standards is always a cost and a headache. And any institution or country adopting AOFI accounting standards don't pay for it. So it is just an effort that we do for ensuring that the industry works on the right direction. And again, AOFI's operations are funded by all institutions around the globe. But my point is that having a new standard for the sake of having a standard and having a new standard, that it may generate some revenue for AOFI, nothing like this happens. Only thing that what we try to do here is to do the right things in line with Sharia principles and rules, because Sharia is paramount for us. Now, first section talks about adoption and consistent application of accounting policies. An institution shall adopt and consistently apply accounting policies in respect of transfer of assets between various investment pools in line with the requirements of this standard and relevant AOFI phases and applicable Sharia principles and rules, duly considering the business model of the institution as well as the contractual arrangements with the respective stakeholders. General presentation and requirements in phase 1 and other AOFI phases are to be applied. Then we have an institution shall disclose in reasonable details the accounting policies adopted in respect of transfer of assets between investment pools. Such disclosure of accounting policy shall include, as applicable, the following categories. So there are 3 types: owner's equity, quasi-equity, off-balance sheet under asset management. But within them, there can be more categories also. So we have listed what are the minimum set of accounting policies. If they do not apply to your institution, you do not need to disclose them. But if they apply to your institution, then you have to take all the 6. So transfer from owner's equity to category or investment pool within quasi-equity and vice versa. Transfer from owner's equity to a category of investment pool within off-balance sheet asset under management and vice versa, or transfer within categories of owner's equity. Even within categories of owner's equity, you can have maybe Sharia compliant preference shares. You can have more than one pool within the owner's equity, and you can have, for example, tier 1 sukuk, which are based on a mudarba or musharaka model. So there can be still different options within the equity. Transfer from a category or investment pool within quasi-equity to a category or investment pool of off-balance sheet asset under management and vice versa, and transfer from a category or investment pool within quasi-equity to another category of or investment pool within quasi-equity. So we are talking about quasi-equity to quasi-equity, like a normal pool, Urea pool to FIA, that is financial institution pool, or HNWI, high net worth individual pool. Transfer from a category or investment pool within off-balance sheet assets under management to another category or investment pool of investment pool within off-balance sheet assets under management. So these are the 6. Actually, 9:9 will be 3:3 would be 9. But actually, if you see, it looks like this if you make a graph. So actually, these are the 6 which cover all the 9 type of transfers. Sister Ghalia has another question. Is it possible to put in the appendix a matrix of asset transfers between investment pools and impact of each transfer? Sister Ghalia, actually, what would be contained in that matrix? Please, if you can try to try to put a bit more detailed in your question or comment, then the idea seems interesting. But to be honest, what would be contained in that, I'm not very clear. So I'm not closing your question. I would request you to kindly add some comment to this, that what type of information you are expecting in that. Presentation and disclosure in the financial statement. So disclosure should include the basis and reasons that govern the transfer of assets. So the basis and reasons. So we are not saying that you apply this base or this reason only. That is, as I mentioned, it has to come from Sharia, from regulation, from governance standards, and from contractual arrangement. But accounting, we are just asking that what are the bases and reasons to transfer. Tangibility ratio and other restrictions applicable on transfer of asset between investment pool in line with Sharia principles and rules. C, any restriction in line with Sharia principles and rule on short-term transfer of assets with expected return to the original investment pool to avoid a buyback transaction. Sister Farida, I think, as I mentioned, in the significant changes, we need to identify this one as one of the Sharia issues. Okay. Now, let me explain this to the participants. So now, for example, there is a liquidity crunch. So I have right now only one investment pool, that is Urea pool. I took out one sukuk from that, and I needed 1 million BD from a financial institution. So I created a FI pool for that financial institution. I took out that sukuk and transfer it to that investment pool. And from that, I'm giving return to that FI deposit for 1 month. After 1 month, that FI pool will close. Where the asset goes. Normally, if I have only one pool, then the asset comes back to me in the original pool. Now the question is it a buyback? If we consider the urea pool as a separate virtual entity and the FI pool as a separate virtual entity, and only the asset was transferred for 1 month, at times it is only for 7 days, at times it can only be for 3 days. We have seen these things in the market practices. Even if it is 3 months or 6 months, it is because even if it is less than 3 months or 6 months, it is less than the period which is normally defined by Sharia scholars of 1 year to avoid the buybacks with regard to the tangible assets. Like in case of Ijara with Tamliq with sale and lease back, scholars normally require 1 year of the minimum time of lease. So the question is, whatever type of instrument it is and whatever type of transaction, this transaction structure is underlying this instrument. But the question is this 1 month transfer or 7 days transfer or 2 weeks transfer or 3 months transfer, is it a type of buyback? Unfortunately, we believe that some of these may become a buyback transaction and which may be subject to Sharia restrictions, and some of these may not be considered fully compliant with Sharia as we understand the requirements of AOFI standards, etc. So this is one of the challenges that has to be addressed. And again, from accounting, we are not putting the restrictions. Rather, we are just saying that the restrictions, if any, which are there on this one should be disclosed. It is more like a deterrent that you need to disclose any restrictions. Any restrictions and any specific valuation approaches applied to transfer of monetary assets in line with Sharia principles and rules, as I talked about, with the tangibility ratio and others. So I think Sister Farida, B and D should be together and C should be after that, because B and D are more related to each other. Treatment of changes in classification of investment in sukuk. Now, this is another example. Now, what happens that I have a held to maturity instrument. Now, held to maturity instrument is not carried at fair value. Now, if I transfer that held to maturity instrument to another pool, what happens that technically this pool is not having it at held to maturity. The other pool, if it is transferred at the amortized cost value, which is not the fair value, it might be injustice to one of the pools. And if it is transferred on fair value basis, then what happens about the overall accounting by the institution, which was being done on a HTM basis? So this is a very important and actually very complicated issue at times, that some of the instruments which are kept in one pool may be subject to another requirement. Like another example is that an institution has a subsidiary in a foreign country, for example, even in the same country. Okay, let's take a simple example. In the same country, doing a business similar to another type of financial institution, or doing a real estate business or something else. We have some examples like this. Now, what happens that being a subsidiary, in the books of separate books of account, we are not talking about the consolidated books, because normally the profit and loss distribution is done based on the separate books or standalone books of account, not based on the consolidated books of account. So considering this thing, if I transfer subsidiary shares partially, not fully, because there is need for more assets in the investment pool, because there is there are, for example, some of the investment assets in the investment pool are matured, or if additional urea deposits have come in, so there is a gap between the assets and the cash. and you cannot immediately create new assets. So you have to transfer some of the assets from the shareholders pool. Now, if you transfer the shares of the subsidiary, which is not preferred, but still if you transfer the shares of subsidiary, which is allowed, not preferred, but allowed. So if you transfer that, what accounting will apply to that? Because in the shareholders pool, you were accounting it at cost only, with only dividends coming in. Dividend will come at the end of the year. So if you transfer it now, there will be no profit on that. Similarly, the fair value of that instrument, that share, might be quite high or maybe quite low as compared to the carrying value. If it is quite low than the carrying value, then we can expect there will be an impairment also. So you can expect that, okay, you take with impairment. But the management may say, no, it's a new subsidiary, and in the long-term future, we do not expect an impairment because we have a good cash flow model with that. So even if the fair value is less, there is no impairment on that. So what applies, what accounting treatment should apply when you transfer it at the fair value? Or if you don't transfer it at fair value, would it be justice with the investment account holders? And it can be the other way around as well, that the fair value can be much higher, but the value at which you are carrying in your books is not the same. In case of associate, you may be applying the equity method of accounting, but that equity method of accounting is not equal to the fair value. So if you transfer it to this pool, you do not know. Even the equity method of accounting requires financial reporting at those days. So you may not have the financial reporting of that equity method based accounting available today. It might be 3 months old financial reporting. It might be 2 months old financial reporting, because these are not subject to very frequent financial reporting, but the fair value is subject to very frequent changes. So these type of instruments may have a different accounting treatment in one of the pool, and the other pool may have different investment objectives, which may require fair valuation. And at the same time, it is also possible that the difference between the carrying value and the fair value is material, which means that one of the respective pools is being is subject to injustice, and the other one is getting an undue advantage because of this transfer. So this is something which is very important, that at times when you transfer one asset from another, even according to the risk appetite and the approach of being applied by the other pool, you might even need to change the classification of those assets. So from cash, you need to maybe you need to move it to from cost basis, you need to move it to fair value basis, or from HTM to available for sale, for example. I think we have some questions in the Q&A tab. Let me take those questions. Okay, let me try to first complete, because this let me complete this para only. The commitments and restrictions applied by the mutual contractual relationship between investors of various investment pools that also need to be disclosed. The basis applied by institution in valuing the assets to be transferred, and the rationale in line with the relevant AOFI phases and applicable Sharia principles and rules and the respective business model in case such valuation is different from fair value. So these are the disclosure requirements, main disclosure requirements with regard to that. And then these are the qualitative information, accounting policy and accounting policy related. But then in the next section, we have the quantitative data related requirement, which might be difficult for some of the institutions. We would like to listen to the views of the market with regard to this quantitative data in particular. So, but before moving to the quantitative data, let me take the questions. Sister Ghalia Shamli has said that, can I send the metrics I'm thinking of via email? For sure, sister. It will be very good if you can share the metrics by email to either to me directly, or better if you can send it to accounting@aofi.com. So we'll take your comment to the working group and we'll see how value. I'm sure that it will be adding value. The only thing will be how we can incorporate it and whether or not the working group agrees with that. So we will highly appreciate if you can send that matrix by email. Thank you very much, sister, again. Brother Saud Al-Khudair has again put a question. Brother Umar, is the PSIA considered as separate entities? Brother, we are saying virtual entities. Virtual entity mean that we believe that the ownership structure of the underlying assets is different from the normal ownership structure of the institution, but they all are operating within the same institution. They are not taking legal form of a different company. So the corporate entity is only the Islamic financial institution or the Islamic bank. But within that Islamic bank, there are multiple set of stakeholders having ownership of multiple assets. So it is not one single ownership structure, and it's not one single set of underlying assets in which everybody is having a share. So it's not like for example, in a normal company where I do the trading business or manufacturing business, the shareholders, all of them share proportionately the ownership structure of the underlying assets, and they share proportionately the profit and losses. Even they do not have any profit and loss distribution mechanism different than the proportionate profit. Everybody gets a proportionate profit on their shares. However, for an Islamic bank or Islamic financial institution, at times there are different ownership structures in form of quasi-equity, etc., in which the underlying assets are different. So it is quite possible that my urea account is invested in one pool and your urea account is invested in another pool, and my investment pool ends up in losses while yours remains in profits. This is even possible within an Islamic financial institution. It is also possible that the investment account holders gets profit and the shareholders get a loss. It is possible because their investment pools are different. And more than that, there is a common example on which a lot of people actually criticize Islamic banking, that it is quite possible that Islamic bank shareholders are making huge profits and the investment account holders getting very little bit of profit. So all these situations actually are happening because there are different ownership structures within the institution, and there are different profit and loss distribution mechanism applicable to those different ownership structures. From that perspective, Brother Saud, this standard is to be read in line with the requirements of the FAS 27, which is already there. This is FAS 21 and FAS 27 being revised in form of 4 standards. So the outcome, which is like part of the same project is this standard plus quasi-equity standard plus off-balance sheet asset under management standard plus control standard. So these are actually the outcomes of the same project. And again, the quasi-equity, we have clarified here in this standard that these are virtual entities. Virtual entity in our understanding is a set of a pool of assets or liabilities which is owned by a set of stakeholders, but it does not take form of a legal entity separately. I think I'm clear on this part, Brother Saud. And then we have a question from Abdul Hafiz Al-Bahassani. Can you transfer the asset from conventional investment to Islamic investment? It is a good question. It is possible that actually there is a conventional institution that has an Islamic window, and that conventional institution may have an asset which is Sharia compliant. We are assuming it is that it is parked in the conventional, but it is Sharia compliant. And the institution transfers it to the window, Islamic window. As per AOFI, even Islamic window is a virtual entity. You need to read AOFI's standardized FAS 40 on Islamic windows, which actually clarifies separate financial reporting requirements, etc. for the windows. So it is, yes, it is possible that if the conventional has a Sharia compliant investment, so, or there is an investment which becomes Sharia compliant over a period of time. So, for example, it is an investment in a real estate entity, and that real estate entity is now Sharia compliant. So, you want to pass on that investment to Islamic window. That is actually possible. So, yes, you can transfer that asset to Islamic window, and that Islamic window will allocate it either to the owner's equity within the Islamic window or to an investment pool within the Islamic window. Yes, it is possible, but it is very rare. Now, coming to the quantitative disclosures, an institution shall disclose in reasonable details. Again, we know that some of these details are difficult, so we said in reasonable detail, and for sure we are asking about the material information. So an institution shall disclose in reasonable details the cumulative quantitative information for the period in respect of the following: the cumulative amounts of transfer between or where material between significant categories of owner's equity, quasi-equity, and or off-balance sheet asset management at net transfer value, and respective gains or losses recognized in the respective categories where applicable, as well as difference between the net transfer value and the fair value of such assets if the net transfer value is different from the fair value. This is a difficult disclosure. We believe that maybe in future, if we need to provide some guidance on this one, Sister Farida, I think we discussed it earlier as well. For this one, probably we need to provide a narrative, a disclosure format. I think we need to provide with the illustrative financial statements once this standard is finalized. Just make a note of for Sister Marjan and team for this one. The valuation differences resulting from the transfer of assets in foreign currencies and the financial effect of those transfers. The nature and terms of significant assets transferred and whether these assets are divisible, separable, and any related Sharia principles and rules applied, as well as the disclosures of significant assets proportionately divided between or where material between significant categories of owner's equity, quasi-equity, and or off-balance sheet assets under management. At times, this is possible that some assets are material. And at times it is possible that those assets, although these are not divided, but they are divided in terms of ownership structure between two investment pools. So this is something that at times happens. It's not very common, but this also we have put in as a disclosure requirement. Transfer of assets and transaction conducted with related parties indicating nature of the relationship. This is again a very important issue. Again, it's more of a governance and justice and equity issue, but this cannot be addressed even on the governance side unless the disclosure is not there. So let me give you an example. There is an Islamic bank which has low rate of return for employees. So the rate that they charge for the commercial customer is 8%, while for employees they charge only 2%. Now the banks put that pool of financings, like for example car financings, to the employees, which is at 2% instead of 8%, which is commercial rate. They put it in the unrestricted investment accounts pool, which means that the average return of unrestricted investment accounts went down. And while the bank was compensating its own employees, or in some situation, the bank has given a discount in rate to an associated entity. So the normal rate is 8%, but the bank has given financing to the associated entity on 5%. Now, if you put that 5% yielding Ijara asset or other asset in the urea pool, it means that you are jeopardizing the right of the urea pool. You are giving them net return because of an advantage which is going to your employees or to your related parties, which means that that impact should have been taken by you, not by the urea. So in that situation, first, it should not happen. And if it happens, there should be a compensation to urea for that. So you should be compensating the difference between the commercial rate and the discounted rate to your associated undertaking or related party or employees. But what we are asking here is the disclosure. So transfer of asset transaction conducted with related parties indicating the nature of the relationship, type of transaction, the total value of these transactions at beginning and end of the financial period and financial effect, whether recognized or recognized in line with the respective accounting policies and relevant Sharia principles and rules. Sister Farida, just remind me, in the quasi-equity standard, I think we have this similar disclosure just on the other side of this disclosure, but just make a note of it so that we don't miss it out. Okay. So with that, we reach towards the end of the standard. The effective date that we are proposing is 1 January 2025. In 2023, actually in 2022, and we issued all of these 4 standards as exposure draft. This year, we are conducting public hearings on all of them, and we intend to finalize them by the end of 2024. which means that, or 2023, we intend to finalize by the end of 2023 or maximum by beginning of 2024, which means that from the date of exposure draft, there is nearly 2 years in effective date, and in case of finalization, nearly 1 year will be there, or more than 1 year will be there. But still, we would love to have any comment with regard to the effective date. If you feel that this standard, along with other standards, need more time for implementation, please let us know either by comments now or through your comments that you can provide in writing. Brother Ikram Muhammadi has said thanks. Shukran Jazila Lakum. Thank you very much, Brother Ikram, and thanks for being here with us. With that, I think we have completed the body text, and obviously this standard will override the earlier standard. I think I think we have a little bit of time, so we can take some questions from the participants. Anybody has a comment or a question they want to raise, or anybody want to say something? We have Brother Abdul Latif Ibrahim. His hand is raised, so I think you can allow him to speak. Please, Brother Abdul Latif Ibrahim, you are allowed to speak, I believe. You can unmute yourself and speak.
Now you hear me?
Yes, we can hear you, brother.
Right. Thank you very much for the chance. My question is that by the end of, it's not a question, but request that by the end, you're going to send us a report in email or something like this of the presentation?
The presentation normally we do not share because it's exactly the same as the exposure draft. The exposure draft is available in PDF format at your website. Sister Farida or Sister Noof, if you can just put a link to the exposure draft. So Brother Abdul Latif, it is exactly the same. So as a policy, we do not share it because we do not want any confusion. The PDF version of the presentation is already available, and you can always have access to it on our website. Sister Farida or Sister Noof will put right now they will put in the chat window a link to the standard itself. I think they have already put it. Then Brother Hundamir has raised his hand. Brother Hundamir, please.
Yes, Brother Omar.
Have you here, and please go ahead.
Yes, Brother Omar. Thank you so much for the presentation. And in the interest of the respected participants, a question to you, Brother Omar. Basically, two questions. Tell us how far, for example, the Islamic banks in Bahrain and Qatar and a few other jurisdictions that follow IOFE from the standards in actual application of the transfer of assets in investment pools. So how far the practice is. I know that the standard actually came about because of the issues in the pool management in Islamic banks, but tell us about the extent of the problem or of the challenge in the Islamic banks. That's first. And the second question,
can we take one by one, Brother Handamir? Can we take one by one your questions?
Yeah, but the second question is related. Just
okay.
Yeah. So now, how about the banks in other jurisdictions that follow IFRS? How do they tackle internally this issue?
Brother Handamir, in a nutshell, there are 2 points. Number one, as AOFE, we are standard setters. And while we are now planning more and more towards evaluating the impact assessments of our standards, and we are planning to develop country reports on the effect of AOFE standards, as well as the significant standards or the bunch of standards, we are planning to do impact studies on that. But as of now, we do not have any means of evaluating this. And particularly, I would like to mention that this standard in particular, for some of the standards, I can even see from the financial statements whether they are complied with or not. But with regard to this standard, as of now, in the absence of the disclosures that we are asking, there is no means to assess what is actually happening. You got my point, Brother Hundamir, that as of now, unless you have access to the bank itself, and you can go and talk to their finance and Sharia guys and the pool management team, and you ask them and try to understand them, which we tried to do while developing the standard. So in developing the standard, we involved experts, and we had some discussions, and we involved, like, even my own personal experiences that I have from the Sharia audit and audit side. From all these things, we actually came up with these sort of things. And obviously, these were discussed with the Sharia and all that. But as of now, with regard to this standard particularly, I have no means to evaluate whether it is there. Now, however, one thing I can tell, the existing standard 21, although it is comparatively, its disclosure requirements are comparatively loose, comparatively easier, still the level of compliance I didn't see in too many of the financial statements in the countries where AOFI standards are adopted. So that is my general observation. And again, this is not possible by AOFI. It is something that has to be addressed by the regulators as well as auditors, that the institutions are complying with the requirements, particularly in the countries where AOFI standards are adopted. So, so the practices have weaknesses, and that was the reason that we are coming up with the improved standard. And yes, we know that as of now, the disclosure level is not good. And in the absence of not having appropriate disclosure, whether it is happening in the right way or not, we cannot assess that. Thank you very much, Brother Handamir, for your question. And I hope I can clarify my part. I know that it's not complete answer to your thing, because it's like a disclaimer of opinion partially.
Yes, no, Brother Omar, that's why I actually said the problem and challenge, because we know that that's why this standard is actually of a huge importance to Islamic banks in the region and those that follow AOFI and even those that follow the IFRS. So thank you so much.
Even anybody who doesn't follow AOFI,
exactly,
they still need to learn from this standard, because this is the pure business model of IFIs.
Yes,
it is how the business model need to be reflected in financials. Even if you don't follow AOFI, still you need to find some ground to find similar disclosures within IFRS, because this is what you are doing already. You are doing multiple pool management. So this all is happening at the back end. Only thing is you are not showing it. We are asking it to show. Even if anybody is following IFRS, they need to find the ways to show it. But to be honest, we have we have not consciously made effort to focus on IFRS side, because we limit to our framework. But yes, this is something both have to do. Brother Handamir, you have another question?
No, that was the question, and thank you so much once again.
Okay, thank you, brother. Then I can see some of the comments coming in the question and Q&A tab. So let me take those. So first is by brother Sayyid Imtiaz Abbas Hussain. First, welcome brother for being with us. How for assets of conventional which are assumed to be Islamic way of maintaining to be acceptable in Islam at the time of conversion to Islamic assets? Brother Imtiaz, let me give an example, very quick example. There can be an investment in a real estate company, and that investment, for example, is like 5% of the holding. I'm just giving example. Now that if that real estate company is fully compliant or has now become fully compliant, and the conventional want to transfer this holding to Islamic window, because Islamic window may need more assets, more good assets on the asset side, and may have more of the urea and less of the assets available right now. So there is no harm in transferring that one to the Islamic window, and then from the Islamic window, it can be placed in the appropriate pool. This is quite possible, and I don't think there is a problem. Only thing is that you need to make sure that the asset that is being transferred is Sharia compliant. Another example is real estate investments by a conventional bank. Some of the central banks don't allow the banks to have real estate investments, but you can have a building, and for example, you are using 5 floors for the head office, and 5 floors are rented out. So the floors which are rented out are eligible to be accounted for as investment property. Now that investment property, if the use of that investment property is for Sharia compliant businesses, and there is no issue of contractually any risk of Sharia non-compliance, then there is no harm that if there is enough money available on the Islamic window side, and some of the Islamic pools may have excess liquidity, in that situation, there is no harm in transferring that investment property to the Islamic window, and Islamic window can place it to one of the pools. So I think these are just very quick examples, and I believe that it serves your purpose, brother. Sister Ghalia has another comment. And do the equity categories mentioned in paragraph D of clause 7 mean the transfer between equity items or transfer between tier 1 and tier 2 calculated in accordance with Islamic capital adequacy standard? This is by FSB. Sister Ghalia, again, always I highly appreciate for senior people like you attending and giving very good comments, highly appreciated. Tier 2 will not be in accounting. I think that most of tier 2 will not be going to equity in accounting purposes. It will be equity only for capital adequacy purposes. But tier 1, if they meet the criteria of equity under IFRS and AOFI standard, they can be put in the equity itself. So yes, it is possible that there can be more than one classifications within equity to which some of the assets can pertain. And yes, this is possible that you can have transfer between two categories of tier equity. Even it is possible that you may have more than one issues of tier 1 sukuk. So you can have a musharaka sukuk on tier 1 basis, and you can have a musharaka sukuk on tier 1 basis, which was issued 2 years later. The first one is maturing. Now, the first one is maturing, so the underlying assets of that may be transferred to the second sukuk. It is quite possible. So from that perspective, I still believe that yes, there are possibilities. However, the classification, it will not be as per IFSB. The classification will be as per AOFI accounting standard, that what meets the criteria. So most of the tier 1 which have no put option in the hand of the investor and have either perpetuity or convertibility or a combination of perpetuity and convertibility, those will normally be eligible for being equity. So some of the tier 2 which are considered for capital adequacy purpose may not be eligible for to be accounted for in equity under AOFI or even under IFRS. I believe I'm able to respond to your question, sister. Thank you again very much for a very important, very pertinent question. We have brother Ibrahim Daud Muzayyan. Thank you, Wafi, for arranging, and thank you very much, brother Ibrahim. And it's our pleasure that we are having people like you attending here. There is comment from Andrei Juravlyov. Regulators have this access. If they follow AOFI, do they question banks' decision in asset allocation to the best of your knowledge? I know some regulators who also perform some Sharia-related assessments during the Sharia-related assessments during the on-site inspections. So I know that even one of my first major experience in Islamic finance was developing Sharia compliance inspection manual for the central bank. So some central banks actually consider these aspects of Sharia compliance, etc. Those who consider these aspects of Sharia compliance, I can tell you that I know that they at times go into these details. But this applies to a limited number of regulators. The majority, as of now, I don't think that they are going in this much detail. But I would like to mention one more thing. It's not only the Sharia issue, it's also the issue of stability of the system. It's also the issue of the fair treatment with the stakeholders. And while regulators have this responsibility to maintain justice and equity with the stakeholders, from that perspective, even if they don't want to go for Sharia compliant aspect, I would like to say that they still have requirement as per their mandate of safeguarding the interest of the investment account holders to go in these details. So this is my submission to regulators who are present here and who adopt AOFI standards, that even if you don't want to go in these details from Sharia perspective, you might need to go in these details from the fairness and equity perspective, which is your core mandate. And Dr. Idris, Muhammad Idris has also thanked us. Thank you very much, brother. Mohammed Tahir, some Islamic banks, after repossessing the collateral offered to them and not recovered fully their outstanding areas, they go further to recover additional collateral beside the one offered to them, like guarantors or family members, if so allowed. Brother Tahir, my quick answer to this is that if it is contractually allowed, or if it is required for the purpose of rescheduling or creating rollovers of transactions, then I don't think there is any harm in that, because obviously the Islamic banks are also having the money from the public, and if one of the customers defaults, it impacts dozens of investment account holders whose earnings go down. So it is not my own money. It is the money of the investment account holders, mainly up to 70 to 80%. So it is not that Islamic banks cannot be too much flexible in that. But yes, in the real situation of iflas or bankruptcy, they should be giving leverage according to Sharia requirements, because the Sharia has, as per the teachings of Holy Quran, in case of real iflas or real bankruptcy, flexibility needs to be provided, first in terms of payment term, and secondly by waiving the receivables. We have comment from Brother Musa Abdul Kisau. Thank you for presentation and for promoting the Islamic finance. Thank you very much, Brother Musa, for being with us. And it is our pleasure and our responsibility. And thank you very much. Highly appreciated. Sister Ghalia also mentioned thanks, and you are welcome, sister. Brother Sayyid Imtiaz Abbas Hussain has another comment. Under depressed economic situation, current value of pool assets will be much lower than the carrying value. So difference of amount will be recovered from shareholders' account and they will hit the financial badly. Is there any financial projection for shareholders in this scenario? Brother Sayyid Imtiaz Abbas Hussain, there are two different situations. One is what is exact requirement of Sharia. According to exact requirement of Sharia, the loss is to be borne by the investment account holders. What is the business model? The business model is that there should be proper profit smoothing techniques, including the IRR and PR. AOFI does not recommend or does not promote the shareholders to take that hit. However, AOFI promotes having good risk management mechanism to plan for the rainy days. In line with the teachings of the Holy Quran and Sunnah, you need to be risk averse. You need to plan for the rainy days. And from that perspective, we have our standard number FAS 35 on risk reserves. And even our governance standards require that you should implement good governance practices. Our new upcoming governance standard on investment accounts also covers the risk reserves, etc., in reasonable detail, requiring that appropriate risk management mechanism with risk reserve should be there. IFSB, as other Islamic finance infrastructure body, being our sister entity, also has their own requirements with regard to the profit smoothing and risk management, including maintenance of reserves, PR and IRR in particular. So from that perspective, for us, it is very important that in the good days, you maintain good reserves in order to manage the returns over a period of time, because the financial assets are normally, financial instruments on the asset side are normally for long term, at least a large number of them. So the risk factor continues over a period of time. So establishing of reserves for having a proper risk averse mechanism is very important. We do not promote shareholders to take directly hit on that part, sir. Brother Salih Ta'ala has another comment. Thank you, Brother Umar, for valuable presentation in terms of building environment to support Islamic banks management. Our pleasure, brother, and thank you very much for joining us. Brother Tahir has another question. Does AOFI allows accounts classification as IFRS? Brother, the quick answer is we allow adoption of IFRS or we prefer adoption of IFRS in any area where AOFI is silent and where there is no Sharia non-compliance issue. So the accounts classification you are talking about, if you are talking about classification here in the meaning of impairment, etc., we have our FAS 30, which is equivalent to IFRS requirements under IFRS 9, more or less similar, but we explain them according to our business model. If you are talking about any other aspect of account classification with regard to the presentation of financial statements, we have our own standards which need to be applied. while we collaborate with IFRS, that is IASB, and we work with them, try to work with them on the areas of mutual interest, but at the same time, we believe that they have much bigger focus and much bigger mandate as compared to Islamic finance industry. And Islamic finance industry needs adoption of AOFI financial accounting standard. So for us, answer directly based on IFRS is I would say no, except for the areas where there is no issue. Thank you very much. And Brother Andreev, again, thank you very much. Brother Saud Al-Qudair has a comment again. Thank you for presentation about tier 2 sukuk that issued based on unrestricted mudarba is the bank proof and ring fence the fund into particular Sharia compliant asset to avoid use the fund to settle some of the liabilities. Actually, tier 1 and tier 2 sukuk, which are based on mudarba, at times we have seen that they take part in the same investment pool of URIA. This has been done in some of the markets that we have observed. I can tell you that at least 2-3 markets I'm aware this is happening for tier 1 as well as tier 2, that these are based on a restricted mudarba and they take risk on the whole asset pool. Taking risk on the whole asset pool reduce the systemic risk, means that if you are taking risk on specific assets, there is more risk of default, etc. But if you are taking risk on the overall investment pool, the portfolio theory actually reduces the overall risk. So from that perspective, we believe that majority of the institutions that we have seen have not ring-fenced it. I think I'm clear on my answer. Thank you very much again. And Brother Abdul Munim Aliyu, Assalamu alaikum. I really enjoyed the presentation. It's real pleasure, sir. Real pleasure that you have been with us. We have comment from Brother Akbar Hakimov, Jazakumullah khair, and you are welcome, sir. With that, I think that we have completed all the questions which were here. I don't know about chat window, but it will be difficult to take it from there. I would like to also thank, before I hand it over to Sister Farida to conclude, I would like to thank all of you in big numbers to be here today. I think we had nearly 400 registrations, and I could see nearly 150 people at a time joining in. And I think obviously that is not a unique number, so maybe roughly around 200 people joined. I can still see more than 110 people here. So for that, I would also like to thank our partner institutions for today's workshop, today's round public hearing. With that, I hand it over back to you, Sister Farida, and thank you, everybody. Assalamu alaikum.
Thank you, Brother Omar, for the insightful presentation, and always, I'm sure the participants benefited tremendously. Special thank you to all the participants for their comments and making this event very interactive. Thank you to our team and colleagues in IOFI. As mentioned earlier, we are holding one more public hearing for this standard, for this exposure draft in Arabic, inshallah in October. For any written comments, please send your comments to accounting@iofi.com. And inshallah, we'll see you again in the near future. Assalamu alaikum.